Last month, Rightmove reported a growing trend of landlords exiting the market. 1 in 5 homes for sale were previously rented. That's compared to 8% back in 2010. And that's just the national average. When we look at places like London, that percentage is much higher. In fact, London itself was the hardest hit, with almost a third, that's 29% of properties for sale, formerly rented properties. In this video, we're going to break down as to why London landlords have been impacted the most by regulations, the impact on the rental sector, but also how some landlords are minimizing the damage and how investors are making the most of the opportunity. Stay tuned. To understand why some landlords are leaving London, let's take the experience of Lucy, a professional landlady here in the capital who's been renting her property for years. And of course, she's been benefiting, like any other business, from deducting her costs from her business. And this for property included mortgage interest. Now, things were going very well for Lucy, and in fact, she had plans on expanding her portfolio. But then the landscape changed. The then Chancellor George Osborne back in 2016 introduced the stamp duty surcharge and put Lucy's expansion plans on hold. But the biggest blow was the introduction of Section 24, which was put in between 2017 and 2020, which meant Lucy could no longer deduct her mortgage interest fully. In fact, it was replaced by a tax relief capped at 20%. Of course, this increased her tax bill, and although it made things very challenging for Lucy, she held on, hoping that things could improve. And then came the pandemic, which for a short period of time, it made things challenges, but with challenges come opportunity. And short-term rentals started to boom. She saw this opportunity and converted her property. With that lockdown easing and more travel coming into the city, she was able to convert her long-term rental into a short-term rental property, meaning that she was getting much more rent than what she was getting before. Lucy can once again offset her mortgage interest as costs, and again business was booming. However, the rise of short-term lets have sparked concerns across the country and has pushed government to take action. And one of these includes that in April 2025, the tax system for short-term rental and long-term will be absolutely the same. Of course, this has an impact on Lucy. Where she had found a way to make her numbers work, now she's going to be at 2025 in the same position she was a couple of years ago. And that's not a place that she wants to be, and she now needs to look at alternatives, either again diversify or sell up if those numbers simply do not work for her. For landlords like Lucy, this means that she's going to be back in square one because she's not going to be able to deduct her mortgage interest. And in fact, there are rumours that councils may be looking to double and triple their council tax. And this is a position that a lot of landlords have found themselves in. If you are looking to invest in property in the UK, make sure you subscribe to the channel because we keep you up to date with market changes every week. Well, Lucy's story does mirror a lot of landlords' experience here in London. The situation isn't quite the same across the UK. In fact, when we look at the North and the Midlands, we know that property prices are lower and yields do tend to be higher. So there's a little bit more maneuver when it comes to those figures. And a lot of landlords, instead of selling up, are looking to minimize their tax burden. And one of the ways they're doing that is turning to limited companies. In fact, if we look at September alone, there was more than 5,000 limited companies set up across Great Britain to hold buy-to-let properties. This is a 28% increase compared to the previous year. Between January and September 2024, there's been more than 46,000 limited companies set up by landlords so they can fully offset that mortgage interest as a cost as a business. By the end of the year, it's expected to be between 60 and 62,000. And if this happens, it's going to surpass the 50,000 recorded back in 2023. But here's the punchline. Whilst 59% of these companies were set up in the south of England, only 42% of the property purchased were here in the same region. The other percentage were actually up north. So this suggests that property investors are diversifying, especially where properties are lower priced, but also higher yield. But they're still keeping within the same region, so they do see opportunity, which I'll share a little bit more in a second. Despite the challenges in the market, a lot of buy-to-let landlords are deciding to stay put. In fact, Paragon Bank did a survey of 500 landlords and asked the question what the reasons were. Now, one of the main reasons were that continued demand in the sector. Over 60% said they were staying in the market because of that. And just purely because they preferred property as an investment. 34% in fact said they preferred it over other assets. And Louisa Sedgwick from Paragon Bank emphasized the importance of long-term planning with landlords who are looking to retire and have property as an investment. And in fact, 43% of landlords were inspired by family and friends, and 39% became landlords accidentally through inheritance or buying a second home. If you are a landlord with a property in London, leave me a comment below. I'm curious, what's your plan for 2025? Between 2023 and 2024, London prices fell by around about 5% nominally. Now, this is largely due because of higher interest rates, but also the decrease in demand for properties. However, if we look at inflation hovering around about 10%, this means that property prices in real terms have dropped between 13 and 15%. This means that a lot of landlords have actually experienced a loss on properties that they're holding. And on top of this, of course, we have all of these regulations that are spooking a lot of people and wanted to exit the market. This spells out a lot of opportunity for investors. And with a lot of landlords leaving London, we have a lot of property investors trying to make the most of the opportunity. In fact, I have these calls all the time where you have investors looking for off-market properties. Now, what are these opportunities? Well, lower entry prices. You also have less competition. A lot of landlords are spooked, wanting to exit the market. Investors are just sitting on the fence. You also have higher demand, of course. I mean, if we look at rent in London alone, it's gone up by 30% in recent years. Capital growth, London always delivers. The funny thing about the capital is that it won't do anything. It will remain flat for a few years and then suddenly it will go through the roof. And it always delivers, never disappoint. If you're a cash buyer, this is a great opportunity for you. Of course, the higher the mortgage rates, this deters a lot of mortgage dependent investors out there. And last and certainly not least are those distressed sales. A lot of landlords need to sell right now. And it's about you trying to find those opportunities. The best way is to make great relationships with estate agencies and find those properties that are not even on the market. So the London property market is undoubtedly facing a real-time price crash. And of course, the landlords are the ones that are really taking the brunt with this, with higher costs and new regulation. And this is great opportunity for those investors who can weather the storm and can really ride out the mortgage rates if you are depending on a mortgage. But again, the important thing here is speak to a property expert, a financial advisor, because I'm no way giving you financial advice, and tax experts. If you are a landlord with a property in London, leave me a comment below. I'm curious, what's your plan for 2025?